So today I want to introduce you to taxation of exempt versus non-exempt policies. Whenever we are in the insurance industry talking in terms of any kind of permanent insurance, invariably when the conversation always comes up to what is exempt and what is considered non-exempt. And it's a very important concept for insurance purposes. The purpose of establishing whether a policy is an exempt policy or non-exempt policy is really to answer this question. Is the insurance really a policy for insurance, or is it an investment? In other words, did you buy this policy because you needed coverage in case you prematurely pass away, or you have estate issues or family issues or whatever it is? Or did you really buy this policy because you really like the idea of investing money and you don't want to have to pay any taxes? In other words, it is an investment policy. So in other words, what is the purpose of all this, okay? And so therefore, because this is primarily involves universal life, basically, as you know, with universal life, we can dump in a lot more money than normal, than all that. So basically, there will have to be some kind of a compromise, you might say, in all this, okay? And so therefore, we said, okay, if it's an exempt product, then it is an insurance contract. And as a result, the growth in the cash value, the investment account, whatever it is, will be tax deferred as long as the money sits in there. In other words, the money's not withdrawn or anything along that line. Okay? And should that person die, whatever it is, all that will, of course, be tax-free. So in other words, if it's an exempt product, then theoretically, it's not for investment purposes, so therefore, it will be considered an insurance contract. If it is a non-exempt product, then really it isn't an insurance product, it's an investment product, which basically means that you lose that tax sheltering, and therefore you're going to end up having to pay tax on that investment, just like any other investment, okay? So that's really where the issue is exempt or is it non-exempt, okay? And so the question obviously then is, how do we maintain the policy in an exempt status, okay? And the only way you can really maintain the policy always in an exempt status would be if the investment account, okay, the investment account does not exceed, and I put this in blue purposely because this is a very important line, the maximum tax actuarial reserve, in other words, the MTAR line, okay? This is the key right here. So as long as the amount of money that's in the investment account is equal to or less than that maximum tax actuarial reserve line, then it is an insurance contract. And so the growth of the cash surrender value, regardless of what you invest your money in, could be dividend driven, could be capital gain driven, interest driven, doesn't really matter what it is. Okay, as long as that growth does not exceed this particular line here, then Ottawa will consider this an insurance contract, and therefore there will be no tax reporting of any kind. No T3s, no T5s, none of that kind of stuff at all. Okay, so that's the key, is as long as that money is within that line, which we'll show you in a moment, it will be considered an exempt contract, in other words, tax-free, basically, okay? Now, there have been some changes since this all came out. The original MTAR line all started, basically, policy last acquired December the 1st, 82 to December 31st, 2016. So in other words, there's been a major change here. Now, up to that point, from December 1st, 82 to December 31st, 2016, basically, what Ottawa used was, you might say, a fictional policy because it doesn't really exist, is a 20-year endowment to age 85. In other words, they would test this to make sure that it stays within the MTAR line throughout that period of time up to your age 85. Then after that, it doesn't really matter anymore, okay? So as long as the amount of money was growing at the same rate as this fictional sort of policy, you might say, of a 20-year endowment to age 85, then it is considered an exempt policy because it stays within the maximum taxable actuarial reserve. Okay, so that's sort of the, like I say, a fictional policy, but nonetheless, that's what they drew on. There has been some changes. And so therefore, a new change would be policy last acquired after December 31st, 2016. In other words, starting January the 1st, 2017, a few things have changed, okay? And the new endowment policy is no longer a 20-year to age 85. The new one will be an 8-year endowment to age 90. okay, to age 90. And that's very important to remember. So you must look at your exam if you get to this point. You must make sure that you read the question carefully, whether it's a policy that was acquired prior to December 31st, 2016, which will fall into these particular rules, and it will be exempt up to age 85. In other words, it's tested up to age 85, okay? Or whether it's a brand new policy last acquired December 31st, 2016, which would be the last time, basically. So in other words, any policies issued from January 1, 2017 onwards, the new policy to establish what this line is an 8-year endowment to age 90. So you might say that these cases here, I know we call them endowments, but sometimes you could also what we call limited pay life. In other words, you only pay for 8 years. And the growth of that cash and everything else grows accordingly to age 90. So we test it. Remember that the testing is done on the anniversary date. It's automatically done by the insurance company. So you as a consumer don't have to worry about all this. It's automatically done on the anniversary date of the contract. And then they will establish whether a policy is exempt or non-exempt and so on and so forth. Okay. So for now, that's the main thing that we need to establish is that what is an exempt versus a non-exempt policy.